Hi guys. Today we will analyze Altria Group's stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. The short-term trend is positive, while the long-term trend is still negative. Strong support levels are around $44 and $41.50. Next strong support level is around $38.50. Strong resistance levels are around $46 and $48.50. Next strong resistance levels are around $51.50 and $54. In the last month the stock has been trading between $42 and $45.90 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 7.6 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a strong downward trend since May 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 2% per year, for last 5 years. We see that the average profit margin of the stock has been around 23% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 170% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Altria Company: bad, average, and good. First scenario. Altria will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 0%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $29. Second scenario. Altria will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1%. Future profit margin would be average, 14%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $38. Third scenario. Altria will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $48. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 0.98. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Altria Group, analysts forecast growth rate around 3% per year in next 5 years, and future P/E around 12. Again, I will use 3 different scenarios for Altria Company: bad, average, and good. First scenario. Altria will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $6. Second scenario. Altria will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1%. Future PE would be average, 16. In this case, the fair value of the stock today would be $7. Third scenario. Altria will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 18. In this case, the fair value of the stock today would be $9. As you can see, today the stock is overvalued, $45, even if we expect the company's high performance in future. Both the profitability and financial health of the company have multiple concerns. Also, the stock is expected to show a small growth in revenue in the next 5 years, 2 to 3% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since May 2022, so, the stock can go lower, before it recovers. I may consider buying the stock for the dividend, when the stock drops to $35. Company's strengths. Altria Group is an American corporation and one of the world's largest producers and marketers of tobacco, cigarettes and related products. Altria is the parent company of Philip Morris USA and other companies. Altria also maintains large minority stakes in the e-cigarette maker Juul. Altria has been growing through investments in companies with products that diversify its portfolio. Underlying trends in the U.S. cigarettes business are stable, and recent FDA actions on e-vapor can benefit Altria earnings. The U.S. market is a highly affordable one, relative to other developed markets. This leaves headroom for price increase for many years. Relatively low capital requirements allow the company to return significant capital to shareholders in the form of an 80% dividend payout ratio. Altria pays a solid dividend, with a yield of about 8%. The company also buys back stock. Risks. Altria sold off recently, as they wrote down their Juul investment. As a U.S. pure play, Altria lacks exposure to some of the emerging markets, in which total tobacco consumption is increasing. The U.S. government has issued several proposals that would hurt the cigarette industry, including a ban on the use of menthol in cigarettes, and a reduction in cigarette nicotine to non-addictive levels. Separately, the Biden administration has imposed higher excise taxes. The U.S. cigarette industry has seen sales decline by about 2% annually over the past several years, due to health concerns and weaker consumer spending. Tobacco companies continue to face substantial legal risks, and potential monetary liabilities in the U.S. The company has negative shareholder equity, which is a more serious situation than its high debt level. The company's return on assets of 4.8% is worse than the rest of the industry. Based on estimates for the next 5 years, the company will show a very small growth in revenue. The revenue will grow by 2 to 3% on average per year. The earnings per share is expected to grow by 6 to 8% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.